Hello, sorry about that. I seem to have got cut off. I did actually finish the lecture, but apparently just to myself. So I'm on slide 13, describing the actions taken by managers in response to the rise of shareholder value um, thinking. So managers responded by adopting business practices to promote shareholder value. They shared underperforming branches of firms in attempts to raise the net worth of their companies. They undertook huge waves of mergers and acquisitions, hostile takeovers, and leveraged buyouts. They outsourced production activities, and they laid off staff. So, for example, things like a lot of firms would this is particular practices on Wall Street, famously, but extended to other parts of the economy as well. Financial firms would do things like fire the lowest performing 10% of their workers each year, or fire teams that failed to meet certain targets. Interestingly, these the gains made from these sorts of operations, so the money that's produced by selling these wings of a company, or by ceasing to pay those particular wages, something like that, things like this, were not reinvested in the firm's productive facilities, but rather were distributed to shareholders through dividend payouts and share buybacks. Just to say that in order to prop up the value of shares and to prop up the value of and the prices of shares, money produced in these short-term ways, not through actually producing and selling more things, but rather through simply cost-cutting measures, would be used to artificially increase stock prices. It's a very short-term sort of outlook that are produced in all sorts of ways here. So what can we say about the inequality effects of the rise of shareholder value? Firstly, the last 30 years or 40 years now have witnessed steady increases in dividend payouts and share buybacks to shareholders. For example, I noticed that Qantas is paying its stockholders dividends this period, I guess this quarter or whatever it is, despite laying off 20,000 employees and not flying passengers anywhere for the last 3 weeks. Apparently, the obligations, the legal obligations that Qantas has to its shareholders are more substantial than the obligations it has either to its customers or to its employees. I'm not saying that that's not actually the case or that there's anything wrong with that, but it's just an interesting example of this sort of thing. Secondly, on inequality effects, perhaps ironically, given that this whole regime is supposed to re-empower stockholders, a key effect has been to enable top-level managers to enjoy unprecedented degrees of wealth. Executive pay has risen exponentially since the 1980s, and this trend has continued even in the face of drops in corporate performance. Thirdly, that second one, the rise in top-level managers, is a key part of Piketty's story, of course, these super managers that we were discussing in last week's tutorial reading. Thirdly, these gains have been made at the expense of employees, wage earners. Corporate restructuring has been associated with job losses and cutbacks, and jobs themselves have changed. Workers work longer hours for lower pay today and with fewer benefits. There's also a claim within the school that we've seen a bifurcation of the workforce. All participants all participants within the labor market are experiencing increased job insecurity and job intensity, but high-skilled workers, managers, and professionals receive higher rewards, higher compensation for accepting this increased job insecurity. Lower tier workers get the negative effects of job insecurity and job intensity without the increased compensation. So what allowed all this to happen? Not so much the intrinsic logic of finance, but rather the institutional changes that occur at the level of the firm that produce a particular understanding of value and the purpose of the corporation itself. But instead of looking at global financial structures, we're really looking at the internal composition of firms. The third school of financialization is called the financialization of everyday life. It understands the changes as the following. By participating in financial markets, individuals have been encouraged to internalize new norms of risk-taking and to develop new subjectivities as investors or owners of financial assets. By participating in financial markets, that is to say, individuals are encouraged to internalize norms of risk-taking and to develop new subjectivities as investors or owners of financial assets. This is the same thing. Excuse me. Underpinning this school is a claim that finance has been democratized in the sense that financial products and services have been made available to larger parts of the population, rather than merely the prerogative of an elite wealthy class. However, alongside this has come the individual responsibility of risk-taking and the calculative assessment in financial management. What sort of finance does everyone engage with? Capital-funded pensions. We're all speculators in the market. A lot of people all workers in the economy over the last 3 weeks have been intermittently checking their compulsory superannuation funds to find out how much money they lost, because we're all part of the financial markets now. On top of pensions, consumer credit, so being able to like the rise of credit cards. I've never had a credit card, but I seem to be in the minority. I don't know why everyone else seems to want to go into sort of mini debt in order to buy their groceries, but the rise of consumer credit. Home mortgages, obviously, but where houses were once simply the place where you lived and were maybe a store of life savings, which you would then sell late in life to consume, to fund your consumption in retirement, or perhaps that you would pass on to children. Today, a household is not only the place where you live, but also the place where you speculate. You buy a house in order to partake in the gains of capital appreciation. Your house also becomes a store of equity against which you can borrow to invest further, to speculate further in financial markets by investing in second homes, in an investor home, for example. There are other mass-marketed financial products that we could talk about, like the rise of Bitcoin and things like this, like types of financial products and that have drawn the masses into engagement with financial markets. Van der Zwaan points out that the democratization of finance has occurred over the same period as the rolling back of the welfare state, meaning that compulsory engagement with financial markets has not so much come as an opportunity for the masses to partake in financial markets in order to augment their wealth, but rather it has appeared as a necessity for people to fund the services that the state used to provide. She writes, coinciding with the financialization of the everyday is a shift towards financial markets for the provision of people's basic needs. Whereas such cradle-to-grave services were previously provided by the welfare state, the employer or the savings account, the individual is now required to purchase financial products to protect against the uncertainties of life. The result of the democratization of finance is therefore not just growth in financial flows, but an increased convergence of finance and the life cycle. With this focus on self-management, scholars of the everyday maintain, financialization has created a new subjectivity, the investing subject. The investing subject is the autonomous individual who insures himself against the risks of the life cycle through financial literacy and self-discipline. What sets this investing subject apart from prior forms of identification is his individual nature. He acts on his own for the benefits of himself and his household. This individualism of the everyday financial regime has narrowed the space for collective subjectivities, which have been subsumed by the expectation of the universality of investment. In terms of the distributional and inequality effects of the financialization of everyday life, firstly, I think, as I've said, a lot of these changes are products of inequality. People have been forced into reliance on financial products and markets out of desperation. Payday lending, loans for higher education, loans for housing in the subprime market, for example, and a lack of alternatives, and for a lack of alternatives, marketed pensions. These things are all not really done out of positive choices and desires for engagement with speculative financial products, but rather because they are necessary to acquire the basics of a good life in advanced liberal societies. Secondly, stated differently, these conditions have been produced by the retreat of the welfare state and the stagnation of wages. So financialization as the expression of the needs of people under increased financial strain is the key story here. And second, I would say that the individualizing effects of these changes, the hollowing out of the possibilities of collectivities that van der Zwaan discusses that existed in social democracy, render individuals more exposed to financial elites than previously. Perhaps if we think about the American health insurance market, it's very difficult for an American consumer to not buy health insurance, however bad the options are relative to the collectivized health options that the rest of the developed world takes for granted. So there are power effects in a number of ways that stem from the individualizing effects of the democratization of finance or the financialization of everyday life. And finally, on explaining financialization, well, what allowed all this to happen? It's difficult to say succinctly, but I would say that the key argument is that it was not only rises in financial stress that caused the financialization of everyday life to play out the way it has over the last 30 years, but the particular context in which the rise in financial stress that households are facing today occurred. One in which neoliberal ideas proliferate and the possibility of collective action to produce things like the traditional solutions to these sorts of problems, these sorts of vagaries, make these impossible to create. So it's not just that households have come under increased financial stress, but it's that households have come under increased financial stress in a cultural context um, where individual solutions are the only solutions available. Okay, that is the end of my explanation section. Here are a few lines of, I guess, provocations for you to think about in relation to these claims that I've given you about the financialization of capitalism to discuss in the tutorials. Firstly, the role of the global financial crisis in all this. While I've obviously used financialization to refer to a series of structural changes that stretch back beyond the last 12 years, and I think all this does happen without the crisis, the GFC is still relevant. We're operating in a new reality post-global financial crisis, one defined by a mixture of slow growth, low inflation, low employment, and a dearth of investment opportunities. This last one can alternatively be called a glut of savings or capital globally. If you think about the increases in asset prices or the increases in the size of global finance alone, or the increases in foreign exchange reserves by states like China and Germany over recent decades, there is a large amount of capital in the global economy, but people with money are finding it very difficult to find places to invest it and receive good returns. So this new condition, low growth, low inflation, low employment, and a dearth of investment opportunities, in some circles is referred to as secular stagnation. Financialization and secular stagnation are, in my opinion, quite likely to be related. One paper that does relate these is Ghosh and Chandrasekhar, I think, in their paper, A Decade of Speculation, which was published in 2018 in my journal, the Economic and Labor Relations Review. Ghosh and Chandrasekhar argue that states' responses to the global financial crisis, predominantly the production of cheap liquidity, had two important effects: a substantial increase in vulnerability due to increased debt levels and unsustainable asset price inflation. So the responses to the global financial crisis produced huge amounts of debt, and this made households much less resilient. In a downturn, if you lose your job or if you have an accident at work or something, households are much less capable of getting by as a result of the increases in the amount of debt held. Likewise, the asset price inflation has not only ruled a huge part of the market out of a huge part of owners out of key markets, out of housing markets in Sydney where we are. It's just impossible to, the distance between the average income and the average home is much greater than it's ever been in history. But also, it's quite clear that the asset price inflation is not, it's not possible for this to continue over a very long period of time. So we've moved from, we've settled into this rhythm of asset price bubbles and financial crises. They write that a consequence of these processes is a massive increase in income and wealth inequality across the world, which limits the level of effective demand and growth. So their claims are that the increases in debt are related to increases in income and wealth inequality, and these are in turn related to this new secular stagnation, which we're still in the middle of. As a second provocation, there is this question of whether financialized capitalism operates according to logics which don't appear in industrial capitalism. Lisa Adkins, who is the head of the head of politics at Sydney University and one of the authors of your reading for this week, in her, I think it's 2018 book, The Time of Money, observes that within financialized capitalism, certain logics and behaviors appear that would be impossible within industrial capitalism. For example, households can have debts that outstrip the probabilities of their repayment. Within industrial capitalism, no one would issue this sort of debt. No one would issue debt that we wouldn't expect anyone to pay back. Within financialized capitalism, however, it's quite possible for this situation to arise. There's a couple of reasons for this. Firstly, as I've said, within financialized capitalism, it's quite possible that the issuers of debt are not going to keep holding it, but rather they're going to securitize it, pass it on, and they're not going to be very concerned by foreclosure on that debt. Secondly, I would say that where money is coming from within a bundle and securitize model is not so much the successful repayment of a debt, but rather its ongoing payment. So what financial actors are trying to create within financialized capitalism is ongoing debt streams. This is the product which is extremely valuable, which can be bundled with other income streams and securitized in the logic that I've given you. So it doesn't really matter if households have debt that they're never going to pay back, they're never going to get out from, as long as they continue to pay their interest each month. Say a household that never pays any of the primary, what's the primary bit of their home loan and only ever pays the interest payments. This is still an income stream that can be securitized and profit can be made by that within financialized capitalism. Secondly, we can talk about, Adkins points out that there are a lot of wages within economies, the advanced liberal economies today, that don't cover the cost of life. Well, Marx would say, well, this is unsustainable by definition. If the wage is so low that the worker cannot reproduce him or herself, then by definition, this situation cannot continue. Well, within financialized capitalism, it can continue because the availability of debt is such that workers can cover the shortfall of their income with their consumption needs by taking on greater debt. Secondly, we can say that Adkins points out that there is work within modern liberal economies that doesn't pay at all. Within industrial capitalism, we would say, well, why would anyone do this work? Well, within financialized capitalism, work itself becomes a speculative realm. And one works not necessarily just for the compensation that one receives today, but in order to gain skills and in order to produce oneself, like a narrative of oneself, which might lead to increased earning potential in 5 years' time or in 10 years' time. Which is to say that work itself is subject to this new financializing, this new speculative logic, which we would traditionally not expect there, but expect only in the realm of finance. So Adkins's key story is that securitization, the bundling of streams of income and then producing securities out of these bundles of streams of income is not only central to the intense productivity of money and finance, the accumulation, the profit that gets acquired from money and finance, but is also important to developments in consumer finance markets, meaning mortgage and personal loans in markets. Meaning mortgage and personal loans markets. It has produced an expansion and extension of these markets and transformed the sorts of products available. Much more debt available within the economy. A key transformation is to the calculation of consumer borrowing and the emergence of securitized debt. The calculus is embedded not in the calculations concerning the likelihood of repayment, but rather the calculations concerning the likelihood and possibleness of servicing the debt, in maintaining a stream of payment, even if it's not ever going to be paid off. Thus, it is possible in this new rationality of having debt that outruns working and lived lives, and debt that, if indexed against income, can never be repaid. In this way, mass indebtedness is hardwired into the process of the creation of surplus. And importantly, it is hardwired in that this happens through the movements and flows of money. So Adkins's claim is that we need new tools to understand financialized capitalism because it doesn't work the same way as industrial capitalism. This is something I think is worth thinking about. Finally, and very early set of reflections on what the state's responses to the coronavirus tells us about any of this. Firstly, the massive responses that we've seen in the realm of finance and the realm of the household and productive economies, things like worker subsidies, indicate that austerity is dead. Austerity is the process by which governments claimed after the global financial crisis that it was not possible to maintain high state spending, and that state spending would have to be cut back while governments paid back the debt that had been accrued, that had been built up in the responses to the global financial crisis. The first thing that we can say about the responses to the coronavirus are that the claims that austerity was necessary are completely and clearly falsified. Austerity was a choice, it was not a necessity, and it's clear that governments had huge capacity to do things like print money, to act on things like homelessness and unemployment packages being too small to live on. The claim that states have their hands tied on these sorts of decisions no longer stands. This is worth, I mean, it's a little obvious, but it's worth noting explicitly. Secondly, the size of the response from states is likely to produce a substantial increase in indebtedness generally. So states in a year's time will have more debt overall within the economy than at the start of this year. This does not necessarily mean that the rise of debt will have the same effect as after the global financial crisis, the sorts of claims that Ghosh and Chandrasekhar make in that 2018 paper. The key reason for this is that for now, the increase in debt is predominantly within the public sector. So we're talking about public debt, and states can borrow at rates below, interest rates currently below the growth rate. This means that very sharp increases and very high debt levels are broadly sustainable for states. Why is this? Because the value of the debt is actually likely to decrease simply over time, simply through inflation. If the rate of the at which the debt accrues, the interest rate on that debt is below the growth rate, then over time the capacity of the state to pay that debt back, the real value of that debt will be decreasing. So this is the important point going forward, whether or not we can keep debt on the public balance sheet instead of seeing a sharp rise in household and company debt, in private debts in different areas of the economy. If we do move to if this does continue for a very long period of time, say we're locked down in 3 or 4 months' time, then households and businesses are likely to emerge with much more substantial debts on their balance sheets, and this will curtail their spending capacity much more sharply into the future, and we're likely to see a much slower recovery. And finally, I would say that the political ramifications of these huge state mobilizations are extremely ambiguous. It's very possible that electorates, having seen that there are alternatives to financialized neoliberalism, will refuse to return to it, and that this will open up space for new modes of experimentation, things like Green New Deals and permanent universal basic incomes. You know, the worker the wage subsidy programs being rolled out across Europe and to somewhat lesser. Oh well, I mean in Australia as well, have some commonalities with a universal basic income, and it's quite possible that this will be demanded in some way going forward. On the other hand, there could very easily be a return to the new normal, and I have nothing to say really here except that be wary of people on social media claiming that that the responses to the coronavirus point inextricably to the fact that societies are going to end up at their preferred state model. I've seen this sort of analysis, this sort of happy analysis from a number of different theoretical perspectives already in the media, so I'd be a bit wary of that logic. Okay, that's about it from me. Sorry about the disruption in the middle. I look forward to seeing you all on Tuesday, and I hope you have fun with this week's reading.